All right, let's dive into a really fascinating and honestly pretty powerful financial tool, the call option. We're going to break down what it is, exactly how it works, and the two completely different ways you can use it. But let me just start by asking you a question. What if you could bet on a stock going up and make a ton of money if you're right, but without ever having to buy the actual stock? What if you could do it for just a fraction of the cost? Well, that right there, that's the big promise of a call option. Okay, so to make this super clear, we're gonna stick with just one example through this whole explainer. Let's pretend it's June and a company, we'll call it XYZ Inc., has its stock trading at $52.50. We're zeroing in on one specific call option, the one highlighted here. It expires in December, it has a strike price of $55, and it costs us a $2 premium. Now, don't worry, we're gonna define what those terms mean right now. So let's start with the absolute basics. What are the building blocks of this thing we're talking about buying? What is a call option, really? A call option is actually pretty simple at its core. It gives you the right, and this is the most important part, but not the obligation, to buy a stock at a price you agree on today at any time before a certain date in the future. It's kind of like putting a non-refundable deposit on a house. You lock in the price, but if you change your mind, you can just walk away and only lose the deposit. And that deposit, well, in the options world, that's called the premium. It's simply the price you pay for the contract itself. So for our XYZ option, that premium is $2 per share. That's our ticket to the game. And the strike price, that's that pre-agreed price we locked in. For us, it's $55. This is huge. It means it doesn't matter if XYZ stock shoots up to $100 a share. We have the right to buy it for just $55 anytime before December. So let's put it all together. Here's our move. We buy 5 call option contracts on XYZ. They've got that December expiration and the $55 strike price. Now, each contract usually controls 100 shares, so at a $2 premium per share, our total cash out of pocket is $1,000. For that $1,000, we now have the right to buy 500 shares of XYZ. Now, you're probably wondering, why on earth would somebody do this? Well, it turns out there are two completely different reasons, two different mindsets. You're either in it for pure profit, that's speculation, or you're looking for protection, which is risk management. And look at this, it's like two different players using the exact same tool for totally different games. The speculator is using the option for leverage. They're betting on a price jump so they can sell the option for a quick profit. The risk manager, though, they're using it like an insurance policy to lock in a price for a stock they actually want to buy down the road. It's one tool, two very different paths. Okay, let's go down that first path, the speculator's bet. This is the high-stakes, high-reward side of things, and it's all about one powerful and kind of dangerous word, leverage.
All right, scenario 1. Our bet pays off, big time. We bought our options back in June, and just a few months later, by September, XYZ stock has jumped from $52.50 all the way to $60 a share. We were right.
So how did we do? Well, that little option we bought for $2 is now worth $6.70. If we sell it right now, we make a profit of $4.70 for every $2 we invested. That, my friends, is a staggering 235% return. Just incredible. And this is where you really see the magic of leverage. If we had just bought the stock itself, we would have made a very respectable 14.3% return. Not bad at all. But by using the option, we multiplied that return by more than 16 times. That is the speculator's dream right there. But, and you knew there was a but coming, leverage is a double-edged sword. What happens if we were wrong? What if, by September, the stock didn't go up? Instead, it plummeted down to $45 a share. In this scenario, our $2 option is now basically worthless. It's trading for maybe 25 cents. If we sell it just to get something back, we've lost $1.75 per share. That works out to a painful, gut-wrenching 87.5% loss on our $1,000 investment. And again, just compare that to owning the stock. If you just bought the shares, you'd be down 14.3%. That stings for sure, but you're still in the game. With the option, that exact same leverage that could have made you rich just amplified your losses and wiped you out. That's the risk, and it is huge. Okay, deep breath. Let's completely shift gears. Forget the speculator for a second, and let's look at that second path, using call options not as a bet, but as a safety net. So, picture this. You're a fund manager, and you know for a fact that you have to buy 50,000 shares of XYZ stock in December. But you're nervous the price could skyrocket before then. So what do? You buy call options as insurance. And here's how that insurance policy pays off. If the stock does soar to $60, the manager is calm. They just exercise their options and buy all the shares they need at their locked-in $55 price. Add in the $2 premium they already paid, and their total cost is $57 a share, a huge win compared to the $60 market price. But what if the stock tanks to $45? No problem. They just let their now worthless options expire, and they buy the stock cheap on the open market. Their effective cost becomes the $45 market price plus the $2 they spent on the premium, so $47. In either case, they were protected. All right, let's jump back to our speculator for a minute. Remember our winning scenario? The stock hit $60 in September, but our option is still good all the way until December. And this right here, this is where things get really, really tricky. Do you sell now and take the money, or do you hold on and hope for more? To get this, you have to understand that an option's price is made of two different things. When our option was worth $6.70, $5 of that was what's called intrinsic value. That's its real on-paper value. The stock is at 60, our strike is 55, so that's a $5 difference. Simple enough. But that other part, that extra $1.70, that's time value. You can think of it as the market's price for hope. It's the value of the chance that the stock could go even higher before December. And the source material just nails it when it says this decision is not easy. It's because those two parts of the price, the real value and the hope value, are constantly in a tug of war. And that really brings us to the single biggest takeaway of this whole explainer. When you hold a call option, it all boils down to one fundamental and frankly agonizing trade-off. This is the dilemma, plain and simple. If you sell early, you get to pocket all that juicy time value before it melts away, which it will, guaranteed. But the risk? You could miss out on a massive future gain if the stock keeps running. On the other hand, if you hold on, you're betting that the stock will rise so much that the growth in your real intrinsic value will be bigger than the inevitable decay of your time value. It's a race between potential profit and a ticking clock. So, in the end, a call option isn't good or bad. It's just a tool. It can be a high-powered lever for speculation with all the incredible gains and devastating losses that come with it. Or it can be a simple insurance policy to manage risk and sleep better at night. The strategy you choose depends entirely on your goal. So the question is, what does this tool mean to you? Leverage or insurance?